Welcome to Fidelity Soundbites, a straight-to-the-point monthly podcast where you'll learn from some of Australia's leading portfolio managers on what's happening in markets, how they're positioning, and the outlook going forward. Given reporting season is now finally done and dusted, we thought it'd be great to discuss Fidelity's views across the Aussie market in one episode. So I've bumped off Andrew and brought in James Abella, Portfolio Manager for the Fidelity Future Leaders Fund, and Casey McLean, Portfolio Manager for the Fidelity Australian Opportunities Fund, so we can cover all the way from small to large caps. Great to see you, gents.
Thank you.
Hi, Paul.
First, let's kick off. August reporting season, incredibly volatile, a lot of dispersion, a lot of movements, a lot of, I guess it was also just seemed to be a lot of uncertainty leading into the market. The market's still really favouring current earnings rather than future. And I think that's some of the volatility and some of the dispersion. Is it fair to say that? How did you see reporting season?
Certainly, look, for Aussie mid and smalls, it wasn't as bad as feared, I guess, is the key thing. Expectations had been lowered substantially going into the reporting season. However, there were some very strong price reactions, as you mentioned. If the companies didn't deliver, it got really hit hard, but if they did, there was quite a few movements upwards. So Altium, for example, delivered a good result. It's an expensive stock. It's on a high PE, but it did well, and it has a very strong outlook. It was up 20% in the month, but Iris was down 30%, so 50% price dispersion. So we're saying expectations have come down, but 50% price dispersion on two stocks. So I think definitely still the theme remains. If the companies can deliver on growth, deliver on visibility, and deliver on confidence, they're the key things that are holding up the stocks. Otherwise, there's big price dispersions that come through.
Yeah. Casey?
Yeah, that's right. It was a really volatile month, and I think I'd sort of classify the market as being aware that there's a macro slowdown underway, but the collapse that many people feared didn't really eventuate. So FY23 results were broadly in line, but the real action was in the outlook statements and guidance for 24. And broadly speaking, revenue wasn't too bad. The market's relatively good at forecasting revenue. I think the surprise was really on the cost side, costs and capex, where it meant that earnings across the market were down quite sharply. One of the worst reporting seasons for revisions in about 10 years. And it's really at that cost level, the wages, the interest bills, capex going up. And that also meant that free cash flow was revised down a lot across the market, but particularly in the commodities space as well. Yeah.
Well, let's delve into that a little bit. I think that's right. So I think, if you had to categorise reporting season, it really was about costs, as you said, interest costs, operating costs, and capex costs, I think, which is the interesting thing. If I start with you, Casey, where did you see those costs coming through? Were there some companies that were more exposed to it, some that were less exposed to it? How do you categorise that some of that cost impost in reporting season?
Yeah, I think management of costs was a differentiator in the results, and I think it will remain a differentiator going forward as well. And I think it's most interesting to compare some peers in different sectors. So, for instance, in the banks, Westpac reported their third quarter trading update. The jaws are negative there. Income growth is flat. Costs are rising. They're rising at an annualised at a pace of about 5% quarter on quarter, which is double that of CBA, even though it's coming off a lower base as well. And they're really seeing that the pressure coming from wages, from supplier costs, and from technology costs as well. That was one. I think in supermarkets there was a good divergence there as well. Coles reported higher than expected costs. Part of it was one-offs on their supply chain e-commerce strategy, but there was some permanent increases there again, in wages, rents, and the like. But the interesting thing they called out there was stock loss or shrinkage. Retailers speak for theft, which has increased about 20% year on year. Some of it's from organised crime, but the majority is just petty crime. It's a response to the cost of living pressures. And, Coles called out that they've been made an easier target because Woolworths has invested in technology. The scan and assist thing, you might have seen, that checks what's left in your trolley that you haven't scanned before you go out. Yeah, so that was interesting. Then another sector I call out some divergences was in this sort of asset heavy sectors, the property infrastructure companies. So if you look at the likes of GPT, a diversified REIT, they saw their interest costs go from 2.5% in FY22, jumped up to 4.1% in FY23, and are guiding to 5.2 in 24. Whereas you compare them to Transurban, asset-heavy infrastructure company, they saw their interest costs only go up by 20 bips last year. And in fact, overall, they saw a tailwind from interest rates because the interest revenue on their huge cash pile tripled. So it's really, in this case, it was about managing the costs means hedging your interest rates. So I think that's a big theme I've seen is a divergence between how well management are managing the cost line.
Yeah. James, is that same for you in the smaller caps?
Look, definitely the costs are a big theme. So different, but similar. Mining, consumer, and definitely financial. So what Casey's mentioned towards the end, their servicing costs were big. For example, leasing companies had big profit warnings because the cost of carry or the cost of funding was just increasing a lot. And then on consumer side, it was just cost of debts and rents going up. And mining was the big one, probably the most disappointment. Was the centre of capex, rising inflation, staff costs, and all those things came together for that sector being the worst for sort of cost impost impacting.
Yeah. Actually, what I sort of noticed as well was a couple of things. I thought the capex, and as you're saying, blew out a little bit because of cost. But the other really interesting thing to me was a few companies that had larger cash piles actually benefited.
Like Casey mentioned,
Goodman I thought was a great Goodman was a great example of that, where they had a bit more cash and with higher interest rates actually benefited, and a few other companies that had client money as well that they got to see the benefit of that. So some interesting differences there. The other thing I guess everyone was looking at going into reporting season was the impact on the consumer. Now, we have been talking about this for, probably the last almost 2 to 3 years leading into it, that as interest rates have got, higher, that's going to impact the consumer. The consumer's got to slow down. There's question marks about, or are we heading into a recession? I guess our base case at the moment is that it definitely slow down into the end of the year, but no recession. How do you guys feel about that? Do you it's once again the consumer probably didn't, not that they did particularly well, but they didn't do as bad as we thought they could have. But do you think the consumers, it's got to be felt by the consumer as we move towards the end of the year?
Yeah, on retail and consumer, you can't see it. It's very patchy still. You see it in pockets, particularly apparel and household, where there was a lot of demand taken through COVID. Apparel's still very discretionary, but then outside that, things did quite well. So Nick Scali did well. Other consumer names did well, but then also if you just broaden out of consumer, industrials did well, CSR did well, Boral did well, GUD did well. Then going a bit further to financials, Hub and Net Wealth did well. So like if you just look at consumer, then industrials, then diversified financials, you can still see actually quite a bit of positives actually. There wasn't like an overall negative, but where that was sitting was definitely in the apparel and housing segments in consumer.
Yeah.
Casey?
Yeah, no, I agree. I think coming into results, consumer discretionary had very low expectations, and really those expectations were met, and there was a bit of a relief rally, and the sector did perform well. A lot of short covering in there, but I think it's still clear there's a slowdown happening in sales and growth, but it is more gradual than expected. But it is still underway, and I think Macquarie, they covered 24 consumer discretionary stocks that reported in August. Only one of them saw an upgrade for FY24. So it's still happening, but it's not evenly distributed, as James said. I think some of those houseware, like Nick Scali, they saw the slowdown earlier. You only need one lounge that you bought in COVID, and then that's corrected back to trend. But some of these apparel, fashion type items, it's still above trend, still has a way to go. So it's not a one size fits all. And what's clear to me as well, just broader in consumer into the staples as well, is that patterns of consumer behaviour are changing. Right? Again, Coles called it out. They surveyed their customers, and 90% said they're changing their consumption behaviour in some way in response to the cost of living pressure. They talk about the good, better, best category of products. And what they're seeing is a lot of trading down from better to good. But at the same time, people are pulling back from dining out at restaurants and cafes. And some of those people are going from better to best as their treat. So there's kind of a hollowing out in that middle as well.
Yeah.
And there's different companies are benefiting and wearing pressure from those changes, I think.
Yeah. I think the other interesting thing with interest rates, I think we've maybe moved away from thinking, well, how much higher can interest rates go? Because I think we're sort of getting close. If we're not there, we're getting close to maybe the end of the shorter cycle on interest rates. But the question now seems to be much more, how long will we stay at this higher rate? And that can have an impact. I mean, that can obviously have an impact on consumers as well.
Yeah,
if we stay at these sort of rates for a prolonged period, that would have an impact. And I'm probably with I'd agree with you guys that it's got to eventually be felt, and it will be felt differently across different areas as well.
Yeah.
One of the other interesting impacts is property, I think, with interest rates because first of all, residential property tends to go. Sydney and Melbourne lead the country up. That goes up for 4 or 5 years. Property never seems to collapse. But it seems to maybe go nowhere for 5 or 7 years, and that's how it readjusts.
Yeah.
If we go through that same sort of process, how do you look at that and the impact on property and what that means more broadly for markets as well?
Yes, I know for Aussie consumers in mids and smalls, it's not a huge impact. You do see it in consumer, but I think you got to remember, like I said, it's a mixed impact. So a third rent, a third owner, a third have a mortgage. So the impacts on those people are like polar opposites. So if you're renting, you're getting exposed to huge rent increases, 10, 20%, with government talking about some sort of control. A third own outright, and they have money in the bank, and they're getting a benefit, like you mentioned, corporate benefits, in case you mentioned, or corporate benefits from cash in the bank. Those who have cash in the bank, you could put your money in, get 4 or 5% rate. It's really good. So they're going to benefit. But a third of those with a mortgage are definitely impacted. And then do you have how many years have you been in your mortgage? Are you in a high LVR situation? How strong is your employment, etc.? So I think that third category is where you're going to have the largest impact, and it's definitely the later one. So earlier mortgages or high leverage mortgages are where you're going to feel that pain the most, and that's probably where you're going to get the pinch point. Casey?
Yeah, I think at 4.1% sort of cash rate, it's teetering on that point where you really start to feel the pain for the consumer. And so if it is a short rate hiking cycle, when we start to see cuts, you probably get through it pretty easily on the consumer side. But if we have a sort of higher for longer plateau in interest rates around this level, that's when the pain really starts to bite, I think.
Yeah.
So to me, it comes down to services, actually, the non-discretionary, the essential part of the economy, where, it's the things like your childcare and your hairdresser and dentists and the like, where wages are your primary input. And wage growth's accelerating. I think that's pushing up service pricing, means core inflation stays higher for longer for me. So interest rates probably plateau at higher levels. So the longer it plateaus, the worse the outlook for consumer.
Yeah, no, that's a good point. So let's jump on to commodities and I guess sort of the impact China maybe is having on those commodities as well. I guess if we look at the resources sector for the next year, for financial year 24, when I look at it, the resource sector has one of the, expectations of the earnings might be down sort of 9 or 10%. So maybe it's one of the weaker sectors going forward, mainly based on commodity prices. And I would link a lot of that to China. So, China was an interesting one. It had a difficult lead into last year. Then there was a bit of excitement because China reopened coming out of COVID, and then that reopening there's going to be a lot of stimulus, and that would help commodity prices. But maybe that reopening hasn't had as bigger impact, or it's been a bit slower than people expected, and we've gone back into a more difficult period. I mean, there's a few people asking now, look, is China getting that bad that it could become good in that there might have to be some stimulus, but I think the jury's still maybe out on that. How do you guys look at resources and, whether China, whether that it could actually start to have a little bit of a bounce because, things might get it's already so bad there. And Casey, I might kick off for you, given your Chinese experience as well.
Yeah, no, I think that's right, Paul. I think the physical reopening from late last year was much faster than expected. People got out back on the streets very quickly, but the economic recovery really spluttered after about February, after Chinese New Year. And really the Chinese consumer is not spending because they don't have confidence in their income, and there's a negative wealth effect from declining property prices as well. So, the growth is starting to falter. The 5% target the government has there looks less likely of being hit. So they do need to stimulate to reach those levels. But it's where they stimulate, I think, is going to be important for commodities.
Right.
The government has a clear focus on increasing domestic demand and, that fueling the domestic manufacturing sector as well. So I think the stimulus is going to be focused on the consumption side. And at the same time, they don't want property to have another bubble like it's had in the past. So there'll be support measures for property, I think, but not outright stimulus like you've seen in previous episodes. But they have announced two big policies over the last week or so, changing the definition of a first home buyer, which means if you've had a mortgage previously, paid it all off, you can now be reclassed as a first home buyer. Right. So you get a lower down payment rate, lower mortgage rate. And then they've lowered the rate of deposits across the sector as well. And you're seeing that rolled out in Tier 1 cities, most importantly, because there'd already been a lot of policies rolled out to Tier 2, 3, 4 cities, which is where the real problem is in inventory and overbuild. These are the biggest moves so far. I think they've fired all their bullets so far. If it doesn't work, it could be a risk but there is a lot of expectation, I think, built into some commodity prices on the back of it as well.
Yeah, okay, interesting. James, any additional views?
Well, the demand is there. Resources are definitely sort of slowing down anyway because of what Casey sort of mentioned, people concerned about China overall and global demand. So I think that's still affecting commodity prices overall. So you just got to be very careful what you own. And the other side of it is just the cost comment we mentioned.
Yeah.
The cost pressure is significant. So you got labour inflation, capex inflation, finance inflation. So it's tough. It's still tough, actually. So I think you've got to be very specific of what you own.
I definitely saw capex inflation coming through with a lot of the miners in the new build as well. So that you're right. That's a good point.
Yeah, it was really interesting. Just like in the lithium space, you look at it, it affected dividends, right? That Pilbara Minerals, increased their capex and their dividend disappointed. Yeah, stock sold off. Yeah, IGO did the opposite, right? Their capex is probably front loaded and. It was well handled, and they increased their ordinary dividend, paid out a special, which meant the total dividend was almost double expectations. Right, two companies,
big dispersion,
same area, same commodity, two very different outcomes. Right, but I think as well, just broadly on commodities, not all commodities are China stories.
Yes,
I think oil's done very well. It's rallied from sort of 70 to over 90 now. China's part of the story because I think that part of consumption is recovering on track. Mobility, but you've also seen really good supply side responses from OPEC and reasonable demand over the peak summer period. Inventory's drawn down and about to head into the European winter.
Yeah, that's a good point, Casey. It's that's right. It's not all about China with commodities. You talked about energy, but also even just the transition materials. The lithium, the copper, nickel. That's a bigger, more structural story anyway. That's really is independent of economic activity, but more about penetration. So let's try and wrap that up in terms of the reporting season. It's going to be a tricky one for you. So I'm going to give you 3 words. That's all you've got. Use all those 3 words. Don't do 2, or don't do 1. I want 3. But also don't go 4. Now, how would you represent reporting season? What was reporting season to you in those 3 words? Casey, I'll start with you.
Thanks, Paul. Yeah. I would say better fueling of rotation.
Now, that was 4 words. I caught that straight away.
There was an A. Yeah, okay. Better fueling rotation. Yeah.
Now, you're going to have to explain that. I only gave you 3, I know, but you're going to have to explain that a little bit more because I didn't really understand it.
Sure. Yeah, so I mean better in that it was better than feared, better than expected in many circumstances, but it's fueling a rotation. And what I mean by that is I saw that, a lot of defensives that met their guidance, met their expectations, they were sold off.
Right.
Whereas more cyclical companies that did the same, met expectations, they did well and went bid up. So I think there's a bit of a rotation underway.
Yeah. So people are getting ready. They're getting ready for the next move or where the economy's going.
Yep, that's right.
Interesting. James, 3
I'd
words.
say good but patchy.
Okay, that's 3 words. That's good. And in any sort of further
similar vein to what Casey said. I think it was good results, but it is very patchy. So dispersion was just enormous. So I mentioned Altium and Iris, one up 20%, one down 30%. Casey mentioned IGO and Pilbara, one giving special dividend, and I had small caps, down 40% in the August month. So you got huge dispersion going on in stock prices and big dispersion in outlooks and where those companies sit within their industry, even though they're in the same industry in some cases. Their actual management behaviour is so different that just drives significant share price differences.
Yep,
so that's why I say good but patchy.
Okay, well, excellent. Thank you, guys. Now, before we go, just one last question, and I guess it's always the interesting thing to me with reporting season is it's a short-term focus, but it does give a bit of an indication of where we're heading and where things are changing. And I guess as we think about the outlook for the next year or even a few years, has this reporting season changed your outlook for the Australian market? Is it a continuation of what we've been in? Has there been some change in your outlook?
Okay, Casey.
Not in a great deal, but I think as time passes, we're moving further and further through the cycle.
Yeah.
So getting closer to that point where you become sort of pro-cyclical, more aggressive and add to the cyclical companies that are going to benefit from a rebound in economic activity. So it seems to be tracking in line with my expectations, but it doesn't mean I aren't changing portfolio positions to take advantage of the next cycle coming.
Yeah.
Yeah, I'd probably
James,
say similar. I think the cycle's still going pretty well. There is definitely a recovery, but it's not widespread. It's quite specific. But there is a recovery there. The market is definitely looking towards the next phase, which is the recovery phase. We don't see a consumer downturn. We don't see a recession. So I think you don't need to be hiding in defensives. And even when you have a higher rate, defensives have a higher hurdle to jump, whether it's in debt or a higher hurdle of capital return. So there's a higher hurdle to jump for defensives, which make them less attractive anyway. And I think harder for them to outperform the market. So I'd go, we are definitely going more cyclical, supporting those cyclicals in financials, in industrials, technology, for example. Definitely moving towards those areas, which we've been, but probably continue to add. And things that are a bit more defensive, probably letting go. But in terms of the outlook, not a huge amount of change. I do think you just need to be very specific on what you own, know why you own it, and definitely the number one thing is really earnings right now.
Yep. And I guess from my 2 cents worth as well, to me, a lot's getting priced into markets now. I think, I think with the interest rates, the official rate 4.1, we maybe there's one more, but who knows? A lot's getting factored in. Inflation seems to be, coming back down, but it's well and truly factored in. Costs are well known in the market now, so they're getting factored in. Geopolitical risk is getting factored in. Potential recession, like I said, we don't think it will be, but a potential recession is getting factored in. So this thing and lots getting factored into markets now, which to me always makes it a much more attractive investment for the longer term. So you start to stack the odds, you start to stack the odds in your favour. Australia's probably slowing still through the second half, but as you've both highlighted, I think people are now moving from the back foot to the front foot, if I can use that phrase, and looking for really where those opportunities are. And I'm always interested in stocks that are getting impacted by a cyclical downturn, but have a structural long-term tailwind. So that to me really is the opportunity and the sort of exciting part about markets as well. So volatile reporting season, but to me that creates a bit of excitement because I'm getting ready for where those opportunities have presented themselves. Mm-hmm. Okay, well, guys, thank you so much. That was great talking to you. It was a great wrap-up for reporting season. It's always a pleasure to sit down with you two, so thank you for that. And if you've enjoyed this episode, please share it with a friend and subscribe to the podcast via your favourite streaming platform, and we'll see you next month. Bye for now.
This podcast is issued by Phil Responsible Entity Australia Limited, AFSL number 409340. This podcast is intended as general information only and has been prepared without taking into account any person's objectives, financial situation or needs. Please note that past performance is not a reliable indicator of future performance. You should consider the product disclosure statement and target market determinations for Fidelity Australia products available at fidelity.com.au.